if you want to do valuation, you've really got to have a balance sheet which you can trust. Okay, it's a very important part of valuation. You have a balance sheet that's going to come back and hit you, okay, because it has all off-balance sheet liabilities and debt. Okay, there's a balance sheet you can't trust. Notice every time we have a financial crisis, some acronym turns up. Okay, a VIE, an SPE, an SIV, whatever. Okay, they're off-balance sheet mechanisms, okay, which are permitted by the accounting. They turn up and hit you. But the question here was more on the asset side. You know, if I've got fair value accounting, in the particular way we want to model how we handle accounting and equity valuation, do I want fair value accounting? And here's I guess, a recent example. Enron would be a case would say, look, it actually didn't help me, okay, in Enron, the fair value accounting. But a more recent example would be, I'm investing in a bank. And the accountant will say that if I make loans, I'm originating bank, and I put those loans in a portfolio called an available for sale portfolio, I can mark them to fair value, okay? If there are similar loans trading elsewhere, I can refer to the market price. If they're not trading, I can estimate the fair values, okay? Now, let's say we're 2005, 2006, and let's challenge the paper of our colleague that says the housing prices are right, okay? Admit the notion that there is a housing bubble, and housing prices go up, and the price of these mortgage-backed securities and of these estimated value of these mortgages goes up. Then, you know, on my balance sheet, I have these assets written up. Okay, I have unrealized gains recognized. I have my assets written up. Is that going to help me? Well, under a model of how you handle accounting and handle the balance sheet, the answer. There's a question what the appropriate model is for handling the accounting. The answer would be no. This gives me some problems. Okay. Real appealing back to Benjamin Graham. People in my class have heard this. Okay. When I want to really do analysis to challenge the price, I don't want price in the calculation. I want accountants bringing prices into the financial statements. If I bring bubble prices into the financial statements, I lose the ability of the balance sheet to give me an anchor to hold me. Okay. I haven't got a balance sheet I trust. So there is sort of implication of a model first, worked out a model first of how you handle the accounting, okay, as a prescriptive normative approach to equity valuation, then with implications for the accounting that I want to that I have. The second example is maybe closer interest to you, particularly those in finance. Is an issue on value versus growth investing. This is an issue that has absorbed researchers and practitioners, investment practitioners. History of the data shows that the returns to value and the value versus growth stocks differ on average, and the question is why they would differ. What this research does is indicate that the explanation, I should say, may be in the accounting. Okay, and here it goes. Here is the value versus growth returns. This is from the period from 1963 through to 2006. Every year, I rank firms on their earnings to price ratios. Okay. And I form them into 5 portfolios, from low to high earnings to price portfolios. And you can see that, and then within these portfolios, I rank them on their book to price. And so I have 25 portfolios. I do this every year. And then I calculate the returns I earn on these portfolios over the next 12 months, over the next year. And then I average it over all the years. Okay, for the 4 years here. Okay, this is the average returns I would have earned for this portfolio. This is really the demonstration of the value